Coinsurance is a condition that is present in the vast majority of property insurance policies. This condition requires that the limit of insurance carried be reflective of the true value of the property being insured. Failing to insure property to its full value can trigger the coinsurance clause, which can result in partial payment for losses. For this reason, it is very important to understand coinsurance and to be diligent in maintaining proper limits of insurance. Let's discuss this a little further. First, we need to understand the basis of settlement. This can be either actual cash value or replacement cost. Actual cash value refers to a situation where losses to property are paid based on the current depreciated value of the property. Factors such as age, useful life remaining, and market value are considered. A simple way to think about this is if you were to attempt to buy the same property in the same condition, what would it cost? As an example, let's say your building has a roof that is 15 years old. You expect your shingles to last another 5 years. If a hailstorm damages your roof, with actual cash value coverage, you would expect that 25% of the cost of a new roof would be paid. That is, 5 out of the 20 years. With replacement cost, the damaged property is replaced with similar property without regard for depreciation. This means that even if your property was aged at the time of the loss, it is replaced with new property of similar kind. In our example of a roof with 15-year-old shingles damaged by hail, if the roof was insured with replacement cost coverage, a brand new roof would be provided, as the policy seeks to replace. Where actual cash value applies, our limit of insurance must represent the current market value of the property. Where replacement cost applies, the insured value must represent the cost to buy the same property new again. Now, let's take a closer look at coinsurance. Most policies contain a coinsurance clause of either 80% or 90%. This percentage is the portion of your property's value, either actual cash value or replacement value, that you must insure in order to avoid a coinsurance penalty. Failing to insure to at least this amount will trigger your policy's coinsurance clause and result in your claim being paid on a proportional basis. To better understand this, let's look at some examples. Example 1. First, let's consider a home which is insured for replacement cost. Our home in this example, if totally destroyed, would require $500,000 to be rebuilt. Our policy contains an 80% coinsurance clause, meaning the home must be insured to at least 80% of the full replacement value in order to avoid coinsurance. To get the minimum required limit, you would take $500,000 times 80% for a total of $400,000. Insuring to anything less than $400,000 will trigger coinsurance. For our example, let's pretend the homeowner insured their property for $300,000, which is less than the $400,000 required to avoid coinsurance. The following calculation is performed. $300,000, the amount insured for, divided by $400,000, the minimum amount it should have been insured for, gives us a total of 75%. 75% is the percentage of loss that will be covered by this policy. If our homeowner suffers a kitchen fire totaling $100,000 in damages, the policy will pay 75% of this loss. 75% of $100,000 gives us a total of $75,000. This leaves the homeowner responsible for the remaining $25,000 of loss. Had our homeowner insured to at least 80% of the full replacement, or $400,000, there would be no coinsurance, and the full $100,000 loss would be paid. Example 2. Let's look at another example. This time we'll consider a contractor who owns tools used for their work. Our contractor's tools are older and would have an actual cash value of about $50,000 for all tools. The policy provides actual cash value coverage and has a coinsurance clause of 90%. Our contractor works at several job sites and never has more than $20,000 worth of tools at one job site, and so buys tool coverage for $20,000. Let's begin our coinsurance calculation. $50,000 worth of tools must be insured to at least 90%. To get the minimum required limit, you would take $50,000 times 90% for a total of $45,000. $45,000 is the minimum limit of coverage to carry in order to avoid coinsurance. Our contractor is only carrying $20,000 of coverage, but should have been insured at least $45,000. The following calculation is performed. $20,000, the amount insured for, divided by $45,000, the minimum amount the tools should have been insured for, gives us a total of 44.5%. 44.5% is the portion of any claims for tools that can be paid out for this policy. Next, let's pretend our contractor's tools are all stolen from a large job site where they had $20,000 worth of tools. We apply our coinsurance percentage of 44.5% as follows. 44.5% of $20,000 gives us a total of $8,900. $8,900 is the amount the policy can contribute towards the loss, leaving the contractor to pay the remaining $11,100. Again, coinsurance penalties exist in just about every policy, insuring just about every type of property, from homes and tools to farm buildings, equipment, recreational items such as watercraft and ATVs, to personal contents in an apartment, as well as contractors' equipment. The examples show that coinsurance penalties can be very large. At Cornerstone Insurance, we strongly recommend insuring to the full value. To ensure coinsurance penalties are not applied to your claims, it's important to keep in mind that building costs and market value costs of property can shift quickly. A limit of coverage set months ago may cease to be adequate in the face of rapid inflation. Please review your coverage limits carefully. Talk to us if you feel your limits may be inadequate to protect you from coinsurance.